Welcome back to FT Markets. This has been a turbulent time for emerging markets around the world. The US Federal Reserve is unwinding its program of quantitative easing, and the Chinese economy is slowing. Quite a lot of pressure has been building up on emerging market bonds. And with me to discuss the situation and the outlook for the future is Brett Diment, Head of Emerging Market Debt at Aberdeen Asset Management. Welcome, Brett.
Thank you, James.
We have a very interesting situation at the moment. I think the first question to ask is, given the two big pressures on the emerging market bonds, the China slowdown and the US Federal Reserve, what is the outlook now for the future?
Yeah, I think I'd say a couple of things. First of all, you're already seeing quite a large correction, particularly in emerging market currencies. And secondly, the yields available on emerging market local currency bonds are actually very attractive relative to other markets. So we think selectively there are now some quite good opportunities in EM local currency debt.
If we look at the chart here, we've got on the blue at the top EM local currency bonds, and then the green is peripheral European Monetary Union bonds. These are the yields. Now, as an investor, which of these do you think one should be thinking about at the moment?
Yeah, so I think investors look globally. Clearly there are some risks in emerging markets. There are some countries that haven't tightened policy enough, for example, Turkey. However, there are some countries that have done a relatively good job, in terms of India, for example. So I think if you're looking at overall, emerging market local currency bonds average yield of about 6.5% compared to the yields on Spanish, Italian bonds just north of 2%, there's a very attractive pickup available for investors.
Does that make them attractive? I mean, given the fact that, we've got China slowing, we've got the US Federal Reserve unwinding its very loose monetary policy, is that going to continue to allow EM local currency bonds to be attractive?
I think certainly, China slowdown in terms of hard commodity can have an impact for certain countries such as Chile or Colombia. However, we're fairly optimistic that domestic demand is going to pick up. So overall growth isn't going to look too bad. In terms of the Fed, clearly the Fed probably is going to be tightening short rates next year. However, what we think is more important for the market is where long rates are going. And thus far, long rates in the US have remained relatively anchored around 2.5%. So, perhaps we're unlikely to see the sort of severe weakness across emerging markets we did during the taper tantrum in Q2, Q3 of last year.
If we look at corporates, there's also an interesting divergence going on here. We've got on the top, the blue is US high yield bonds, and the red is emerging market hard currency corporate bonds. And we can see the divergence is growing slightly. How should we read this?
Yeah, the way you should read this is look at the different ratings. So US high yield, that's a single B rated asset class overall. Emerging market corporate bonds, overall it's triple B, so it's actually investment grade. So there's a huge rating difference between these two markets. We think there has been some concern about EM corporates, but again, if you look at valuations, we think emerging market corporate bonds should trade a long way through US high yield.
Right, okay. So what we have here is a chart showing the level to which institutional investors around the world are invested in emerging market debt. What conclusion should we draw from this?
Yeah, certainly what we see at Aberdeen is that generally investors have got relatively low weightings to emerging market fixed income, from 4% in North America to 2% or so in Europe and Asia. Given the global yield backdrop, given where German government bonds are trading, given where US Treasuries are trading, then clearly emerging market debt still offers a big pickup. And we think that larger institutional investors will take advantage of the recent week we've seen in emerging market bonds, actually to increase their allocations.
Thank you, Brett. So there we have it. In the opinion of some investors, the sell-off in emerging market currencies may have gone as far as it's going to go for a while. That could mean that emerging market local currency debt, particularly in the bond market, gets more attractive.